the financial records are accurate. Performance, internal control, to make sure accurate. To show people within the business and externally how well the business is performing and comparing it to other businesses. Obtaining finance or credit. This provides potential limits to the current financial position of the business and the legal requirements. The tax authorities and organizations require that financial statements by law. Businesses need to record their financial transactions in ways similar to other businesses of the same type. For this reason, there are conventions that underline the financial recording and reporting of the business's accounts. These are set in a framework of accounting. There are three main areas to this framework. A framework of accounting, and then we have got one accounting principles. Business entity. Financial accounting is based on assumption that the transactions, assets, and liabilities of an entity are to be accounted for separately from its owners. The business entity is therefore considered to be distinct from its owners for the purpose of accounting. Any personal expenses incurred by owners of business will not appear in the income statement of the entity. Similarly, if any personal expenses of the owner are paid by the business, they would be considered to be drawings for the purpose of accounting, much in the same way as cash drawings. The business entity concept also explains why owner's equity appears on the liability side of the statement of financial position. Capital introduced to the business represents a form of liability, not equity. So, but the owner's justifying it is presented on the credit side of the accounts. Materiality. Information is material if its omission could influence the economic decisions of users taken on the basis of the This allows business accountants to use a professional judgment to decide what is material and what is not. What is material and what is not will depend on a certain extent on the size of the business. For example, a customer who owes 1,000 to business having 10 million worth of assets will be immaterial to the financial statements of the business. On the other hand, if the 1,000 owed to business whose assets are 10,000 or less, it will represent a significant omission and is not recorded. If an item is not material, it does not mean it will not be recorded at all, but it does not mean that it may be linked together with other immaterial amounts. Or it may be reported in a different way. Small polite items may be recorded together in the accounts. For example, the tea and coffee with the staff, the paper clips used in the office, and the plant for the reception area may all be recorded together as sundry expenses. All unused items at the end of the year should be valued and included as inventory in the accounts, but it is unlikely that photocopy paper and envelopes will be valued, as it is not justifiable by the time, effort, and cost to value these small value items. The office table will probably be expected to last 5 or 6 years, or even longer. The accounting principles regard this as a non-current asset, and so be shown in the statement of financial position. An asset would be depreciated over 5 or 6 years. However, it isn't going to make a lot of difference to the profit figure. If the £10 cost is shown as an expense in the year it was bought, or if it's depreciated £2 per year, it's immaterial to the profit, and it would not mislead the user of the financial statements if it were treated as an expense rather than a non-current asset. accruals and prepayments in the advance bookkeeping unit. However, under the materiality concept, it's not necessary to show accruals or prepayments for all expenses. The accruals need not be calculated or recorded. Business entity, materiality, going concern. The going concern concept assumes the business will remain in existence long enough for all the assets of the business to be fully utilised. A pencil machine per se, 10,000 expected the last 10 years, that you would depreciate it 1,000 per year, matching the value of the asset to the profits made. However, it's quite different if the business is not a going concern. The business will not be able to allocate it to 1,000 each of 10 years, as it won't be in existence after 12 months. This means a revaluation of all assets the business owns. Also may mean that inventory must be valued in a different way. If you have goods which you must clear, you may have to reduce the selling price considerably to be sure of selling them in the time the business is left. The accrual principle recognizes sales and costs when they are made, rather than when they are paid. This method provides a more accurate picture of a business's financial. Okay. Recognizes sales and costs when they are made, when they are paid. The profits are matched with the expenses needed to make those profits. Match. Match expenses. In practical terms, accruals concept is used when we calculate accruals and prepayments. It's also used when we make a provision for anything. We've seen how we can make a provision for doubtful debts or a provision for depreciation. Inventory is also counted at the end of every year, so that unused stock is not counted in the profit figure calculation. Okay, so accounting policies and characteristics. Financial information presented in financial statement needs to have some key qualities which make it useful for the use of the International Accounting Standards Board. Let's characterize these into fundamental characteristics and supporting or enhanced characteristics. Fundamental characteristics. Relevance. Faithful. Presentation. Characteristics. Comparability. Timeliness. Viability and relevance. Information must be useful to the users of the information. Relevant financial information is capable of making a difference in the decisions made by users. It should confirm the events that have already happened. It should aid the prediction of future events. It's relevant to potential investors to know the original cost of old machinery. It's relevant to know the value of machinery at present. That's why non-current assets must be depreciated. A faithful representation. To be useful, financial information must not only be relevant but must also represent faithfully the phenomena it purports to represent. For example, if inventory is understood to be stock of items in for sale, it is not faithful representation to include the machines which correct, but the information should be free from material error. The estimate should be calculated as accurately as possible. Faithful representation requires that the transaction should be accounted for in a way that represents their true economic benefit rather than the way it is regarded legally. This concept is known as substance over form. An example of substance over form is where a machine is leased to a business for the entire duration of its useful life. All the business and the legal owner of the machine will be recorded as an asset in its statement of financial position, and the business gains economic benefit from the use of the asset. Then there's supporting comparability. Comparability is closely linked with consistency. Comparability helps users see similarities and differences between it. Compare figures to 1 year to the next to see this while keeping the same accounting policies from a year to the next. As there's a good reason for changing, and the change has been disclosed. Items, just the method of stock valuation and the method of patient are both items where comparability is an issue. Timeliness information is timely when it's available to users early enough to allow them to use it in their decision process. All information is not useful to users to make economic decisions. The need for timely information requires that companies provide information to external users on a periodic basis. Many larger companies will produce half-year figures or even quarterly figures as well as the annual figures. Verifiability. A company's accounting results are verifiable when they can be reproduced by others, so that given the same data and assumptions, an independent accountant can produce the same result the company did. If you have an asset worth 10,000, this is verifiable since you can check it against the invoice. If you subsequently have the asset revalued, this is less verifiable since it's subject to personal opinion. We've seen assumptions are an integral part of accounting. Verifiability isn't about determining whether the assumptions a company makes are correct, rather it's about determining whether the accounting result the company reaches is appropriate for the assumptions that have been made. It gives an assurance that the figures represent what they are supposed to represent. Verifiability doesn't have to do with determining the truthfulness of data a company provides, rather with making sure its results logically flow from the data. If a company tells you that total sales are 250,000, the total costs are 150,000, and profit is 100,000, the calculation of is verifiable. If the sales and cost figures are incorrect, the profit figure is not accurate. As mentioned above, verifiable doesn't pass judgment on whether the assumptions made are correct, but whether the result, not just the assumptions. Understandability. First, the quality of information, which makes it understandable by people with reasonable background knowledge of business and economic activities. Understandability requires the information presented in financial reports to be concise, complete, and clear in presentation. The information should be presented so as to ensure that the user can find the information quickly and clearly. However, understandability never requires that any complex information should be omitted altogether due to its underlying difficulty in understanding. It just requires us to disclose information systematically instead of presenting it haphazardly. Financial statements should be set out in a clear, generally accepted format. Notice the accounts should be properly numbered and cross-referenced to the original figures in these statements. business. Small sole trader may well be significant. A large limited company may well be immaterial and unlikely to affect the decisions of the user. Sales may be overstated to falsely show that business is doing well. And then we understated that less VAT will be paid to HMRC. That may be overstated that investors will be misled into thinking that the business is a more secure investment than it is. 3. Ethical principles. Ethics in business by doing the right thing. Business should be not only fair and honest, but also be seen to be fair and honest. Working in a bookkeeping role means you have a responsibility not only to your employer or client, but also to the general public. Sometimes this can be difficult, as what is best for the general public is not always what is best for the client or company you work for. Ethical behaviour attempts to ensure that the same answers are given no matter which bookkeeper is used. This can sometimes be difficult. If you keep financial records for your best friend, then there is a temptation to show the records in the best light for them, possibly by overstating sales or understating expenses. Bookkeepers should show no bias at all, even if there is a temptation to do so. Many businesses will have a written code of ethics. The code will determine how employees or members of a profession, including the AED, should behave. A code of ethics will not only affect how the employee or member acts in the workplace, but it will also extend the behaviour out of the workplace. The interests of the business or profession should be upheld even when with family or friends. So we've got fundamental principles. All accounting professionals are expected to act in the public interest and to promote high ethical and technical standards. However, when dealing with the financial affairs of a company or individual, there can be occasions where the needs of the business are in conflict with the public interest. There have been recent high-profile examples of this, whereby the accountants have taken the interest of the business by explaining how to economise. Or there have been recent high-profile examples of whereby the accountants have taken the interest of the business by explaining how to economise on tax costs, which at the same time deprives the public purse of funds by avoiding tax. Tax avoidance is legal, tax evasion is not. The accounting profession, including the AED, have 5 fundamental ethical principles. You need to memorise these. Integrity. Integrity, this is about being honest, truthful, straightforward, and having strong moral principles. Objectivity, this is about not being influenced by personal feelings or opinions in considering or representing the facts. It's also about representing the facts as they are without the undue influence of others. Professional competence and due care. This is about maintaining professional knowledge and skill and keeping up with new developments, legislation and techniques to ensure that the client or employer receives the best possible service. It's also about not acting recklessly and without due consideration of the facts. Confidentiality is about keeping information acquired as a result of business activity secret. Such information should not be used for personal gain or disclosed to anyone else without explicit permission to disclose it, or where there is a legal requirement to disclose it. Professional behaviour, this is about acting in a professional way both in the workplace and outside. Being a law-abiding citizen and not bringing the accountancy profession into disrepute. Integrity. Integrity is basing one's actions on a framework of principles. It consists of obeying the rules and doing the right thing. This isn't always as easy as it may seem. There may be be pressures to breach your integrity. Doing the wrong thing might be brought about by external pressures. For example, your boss might ask you to falsify some figures. You know you may lose your job if you don't agree, but a person with integrity will not agree to do wrong. They will refuse to falsify facts no matter what the consequences. It may seem that power, fortune, and success can be gained instantly if corners are cut and the constraints of moral principles are forgotten, but to build a reputation of integrity takes years and you can lose it in a second. We live in a world where we believe the end justifies the means. It may be tempting to overstate profits. The investors will put their money into the business. They think there's something wrong with calling in sick, when in actual fact all we want to do is go Christmas shopping. How tempting it is to add a few miles onto the business travelling so we can get a few extra expenses out of the business. In every case, the person committing the act of dishonesty will convince themselves that they had a perfectly valid reason for their lack of integrity. However, this temporary monetary profit comes at a great price. Any trust can be lost forever. The value of integrity is far beyond anything that can be measured. For people in business, it means that investors will trust them when investing their capital, and customers will come again and again to buy their goods with confidence. For employees, it means that the manager or boss will be willing to trust them with additional responsibilities. For the accountant, it will mean the client can trust the advice they are given will be fair, straightforward, and honest. Integrity applies equally to large and small matters. It applies to the recording of financial statements where figures must not be misleading or inaccurate, and it applies to the expense claims for tea and coffee for the staff where the amounts must be accurate and genuine. Objectivity is based on opinion on the facts only, without personal opinions. Stereotypes are based on the opinions of others. For example, if you describe an object objectively, you can state its colour, size, and weight, but as soon as you say the object is ugly, you are no longer objective. Whether it's ugly is based on personal opinion. The principle behind objectivity is that if two separate accountants were asked to give advice on a particular topic, they would both come up with the same answer. If your managing director believes a particular asset is worth 50,000, but a professional valuation gives a price as 40,000, the asset should be recorded at 40,000. The 40,000 is objective because it's supported by a professional appraisal and is not subject to the managing director's personal opinion. There are two basic ways objectivity can be threatened: a conflict of interest. A conflict of interest is any situation that might cause an impartial observer to reasonably question whether your actions are influenced by considerations of private interest. Private interest can include financial interests, interest related to your personal relationships, or interest related to other outside activities. For example, you may suggest that contact be given to a company in which you have a substantial shareholding because you have a personal financial interest in the result. Your professional judgment may be or be seen to be influenced by the situation rather than based solely on the facts. Conflicts of interest can influence a decision either deliberately or accidentally. You may be faced with a situation where a close friend or family member is interviewed for a new job where you are involved in the hiring. Your objective opinion may be influenced. You may be involved with another organisation that offers the same or similar services. If you are an employee of one accounting business and offer a similar service as a sole trader to similar clients, you may be influenced in your judgment. A conflict of interest exists whether or not the individual is actually influenced by the circumstances exist, where the circumstances are reasonably believed to create a risk that decisions will be influenced. Soliciting or accepting excessive gifts or hospitality is a common way in which a conflict of interest can arise. Accepting an occasional gift is acceptable where the gift is unsolicited, modest in value, and provided openly. What is modest in value is not specified, but bottle of wine at Christmas is acceptable. But all expenses paid, a holiday to Bermuda is not. If you accept an expensive gift, it may cloud your judgment and influence your advice or decision. There are two ways to overcome a conflict of interest. You should either refuse the engagement or you should declare the interest of the organisation or client when the decision is made. To undue influence. This sort of professional judgment will be affected due to one person's position of power over another. example, you may be told to report something that isn't true, otherwise you'll be overlooked for promotion. You should not be influenced in this way. If possible, you should report this to a senior person in the company. If this has no effect, you should accept you'll be overlooked and seek alternative employment. The business is acting unethically, if not illegally, and they are most likely to be found out at some point. You don't want to be implicit in unethical activity. This can have an even greater detrimental effect on your career. Professional competence. Professional competence is about maintaining professional skills and knowledge at level to ensure that employers and clients receive a competent service. Continuing professional development, CPD, is the means by which people maintain their knowledge and skills, which you care is act diligently in accordance with the technical and professional standards required by the service offered. There is a requirement to carry out the task or tasks carefully, thoroughly, and on time. Where appropriate, you should make clients and customers aware of any limitations in the service offered, and you should refuse to carry out any tasks for which you are not technically competent. A breach of duty of care can occur when you are trying to carry out tasks without checking your facts and figures, like negligence or through a lack of time. A breach of professional competence will occur when you are trying to carry out tasks for which you have little knowledge or where you have not kept up to date with recent developments. For example, you must not offer tax as a service if you haven't studied tax for the past 5 years. Similarly, you must refuse to carry out tasks on inheritance tax if you haven't studied inheritance tax. Confidentiality. An accountant has a responsibility to act in a client's or employer's best interests. This cannot be achieved if the client or employer believes that the information given to the accountant will be shared with others. Therefore, an accountant has a duty not to disclose any confidential information required as a result of professional and business relations with the specific authority of the client or employer. An accountant must also refrain from using confidential information for personal gain. The duty of not disclosing confidential information is not confined to customers, clients, suppliers, and managers. You should take steps to ensure that this information is not accidentally disclosed in social situations or to family members. For example, you must take care not to talk about business affairs at the gym, restaurant, or on family outings. Even sharing information with work colleagues can be a breach of confidentiality. Confidential information can take many forms. For example, you may find out that your directors are considering taking over a competitor. You may know the phone number of your manager. It doesn't matter how material the information is. You must still keep the information secure and private. You should take care that you do not disclose information inadvertently. You should never reveal information over the telephone or on social media. You can't be sure who will see or hear the information. There are also organizations that collect information for statistical purposes. Reveal information to marketing and data collection agencies without the express permission of the client or employer. The principle of confidentiality continues even after the individual has left the employment or after the relationship with the client has ended. You cannot go to a new job and tell the new employer confidential information about your previous employment. There are occasions where disclosure of confidential information is permitted. There are broadly 3 situations where disclosure is permitted and the client has given permission. An example might be when a client wishes to obtain a loan and the bank or lender has asked for certain financial information from the client. The accountant may be given permission to disclose this information on behalf of the client. An accountant will also need the consent of the client to reveal information to Her Majesty's Revenue and Customs on any tax matters. However, the consent must be explicit and an accountant would be wise to get the permission in writing. 2. When there is a legal duty to disclose information. An example might be when the accountant suspects the client is committing a fraud. The Fraud Act 2006 states that disclosure of such information is a legal requirement. 3. When there is a professional duty to disclose information. An example might be to protect the professional interests of a professional accountant in legal proceedings. There may also be a public interest reason for disclosing information. An example might be when the client's activities will cause substantial environmental damage. Keeping personal information and personal data confidential is required by law and the Data Protection Act. Professional behavior. Accountants have an obligation to comply with relevant laws and avoid any actions that will bring the accounting profession into disrepute. Accountants must not take part in any shady deals. They must not bend the rules to accommodate their line manager's wishes. Professional behavior extends to how you portray yourself as an accountant. You cannot say you are a chartered accountant if you are not. You must also be careful when marketing should not make exaggerated claims. Advertising should not make disparaging references or unsubstantiated comparisons with other businesses. You cannot say that you will guarantee to reduce the client's tax bill, because this will depend on the client's previous financial activities. You can say that you will ensure the client will pay only what is due. You cannot say you are better than the rest. You don't state what exactly you are better at. In any case, you don't have any substantiated evidence that you are better than the rest. Use of financial statements. Uses of financial statements. So far in the chapter we've looked at how financial statements need to be drawn up following accounting principles and ethics, but who are the users of financial statements? Owners. The owner of a business needs to know how the business is profitable. He or she needs to know how much can be taken in drawings so the business is secure enough to continue trading. Potential investors. They will be interested in their potential profits and the security of their investment. The future profits may be estimated from past performance as shown in the statement of profit or loss. The security of their investment will be revealed by the strength and solvency shown in the statement of financial position. The most lucrative investors are the institutional investors, such as pension funds and unit trusts. Suppliers. They will need to know if they will be paid. New suppliers will need to know that the business is financially sound before agreeing to credit terms. Customers. They will need to know if the business can continue to supply the goods in the quantities and at a reasonable price. And this is especially important if the goods are of a specialist nature. Lenders. They will need to know if they will be repaid. They will need to know if the business is solvent and is likely to remain solvent, and this can be established from the statement of financial position. The lenders will also need to know if their loan is secure, as can be seen from the value of the business assets, also shown in the statement of financial position. Employees. They will need to know if the business can offer secure employment and if they can afford regular pay and possible pay rises. Government agencies and the Charity Commission. The government agencies collect statistics from VAT returns and financial statements in order to know how the economy is performing. HMRC use financial statements as a basis for how much tax is due. Tax may be VAT, income tax for sole traders and partnerships, and corporation tax for limited companies. The Charity Commission will need to know that the charity is being run properly. General public. They may wish to know how the business is affecting the general economy or the economy of the local area. A business may provide employment for local people and may use local suppliers for their materials. Some businesses may support corporate social responsibility programs, which may benefit the local environment through sponsorship of sports and local community events. There's also the possibility that management and competitors will use the financial statements. The managers use past performance to prepare for the future, while competitors try to gain as much from the financial statements as possible to the strength of the competition. Managers often use financial statements to plan for the future. They will look at past performance to decide on future activities. Budgets are formed from analysing past financial statements. Chapter summary. When creating financial statements, there is a framework of accounting principles. The accounting principles are business entity, materiality, going concern, and accruals. They're the fundamental characteristics of accounting. There are fundamental characteristics of accounting which are relevance and faithful representation. There are supporting characteristics which are comparability, timeliness, verifiability, and understandability. Financial statements should be free from material misstatements. There are ethical principles in accounting which are integrity, objectivity, professional competence, due care, confidentiality, and professional behaviour. Financial statements are produced for many different types of user. Complete the following table to show which accounting principle best relates to the statement Non-current assets are depreciated on the assumption that they will be used over the next 10 years. That's accruals. The office photocopy paper is not depreciated annually. That's ality. I don't know how you spell it. The owner's investments in the business are recorded as a liability. Business entity. And the closing inventory is counted at the end of every year, so that unsold goods are not included in the profit calculation. Oh no, that's the way around. That must be. This must be going concern. And this must be accruals. That is the business entity materiality going concern. The fundamental characteristics, relevance, and faithful representation. The supporting characteristics: comparability, timeliness, verifiability, and understandability. Complete the following table to show which supporting characteristic best relates to the statements given. The same method of depreciation is used year after year. That's comparability. The financial statement should be set out in a clear, generally accepted format. That's understandability. Your business produces quarterly figures as well as annual figures. That's timeliness. The business premises have been revalued by an independent valuation expert. There was comparability. Comparability, timeliness, verifiability. Complete the following table to show what material misstatement may have happened to cause the user of the financial statements to make the wrong decision. The owner mistakenly believes he can take increased drawings from the business this year. The bank offers a loan to the business, mistakenly believing the business has sufficient security on the loan. That's the assets. Overstated. He can take increased drawings. That's profit overstated. The business received a penalty from HMRC for underpayment of VAT. An investor sold all his shares in the business, mistakenly believing that there would be very little dividend. A penalty from HMRC for underpayment of VAT. Which of the following are among the 5 fundamental ethical principles for the accounting professional? Integrity, confidentiality, professional confidence and due care. Integrity. Professional behaviour. That's not, and that's not. Give one reason in each case as to why the following would be interested in the final of the government bodies. Calculations to whether to Which of the following statements, or match the following statements to the fundamental principles? You should be straightforward and honest when carrying out your professional duties. You should maintain and uphold the good reputation of the accountancy profession and not bring any discredit upon those professional behaviour. You should base your decisions on facts and not allow any personal prejudice, bias, or pressure from others to affect that decision. When carrying out assignments, you should ensure that they are always carried out with proper care and attention necessary so that the quality and sound is made. Do you care? Any information gained should be disclosed as confidentiality. You should ensure that you are sufficiently competent. That's professional competence. Say the fundamental principle is breached in each of the following scenarios. Your manager asks you to record an asset in the financial statements at 50,000. He believes that figure is a good estimation of the value. You agree to the request. Your manager asks you to complete the financial statement of a limited company, but you've only just started learning about limited company accounts in your 80s, so you believe you will pick up as you go along. That's your managing director has a meeting with the potential investor with a substantial amount of money. If the investment doesn't go ahead, the business may have to close. The managing director asks you to overstate the profits so that the deal will be clinched. That's integrity. I'm going to say that's objectivity. Over dinner at your friends, you tell them that you have been working on the financial at T.H. James, but the profit that you only expect. It's confidentiality. Right. Let's check my answers. Consistency, understandability, timeliness, verifiability, I thought it was comparability. Yes, it is meant to be comparability. It should be. Understandability, timeliness, and verifiability. Overstatement of profit, overvaluation of assets, understatement of sales. Understatement of profit. A, B, C, and F. A, B, C, and F. State the fundamental principle is breached. Just find scenarios. Oh, wait, no, here we go. Here we go. Integrity, professional behaviour, objectivity. Yep. Objectivity. Professional due care, integrity, and confidentiality. We've got how much tax is due, tax calc, to know if the loan can be secured on the business assets, to know if they will be paid. the business is solvent.